Hi, I'm Mike Pacito with I Am Global Partner, joined by co-founder of DBi and co-portfolio manager Andrew Beer. Thanks for joining our monthly update on the I Am Global Partner DBi Managed Futures Strategy ETF, ticker DBMF. Well, compared to a whipsawing raucous April, May was pretty calm. Whether clear skies or eye of the hurricane is to be determined, and we'll get into more of that shortly with Andrew. But first, let me explain the visual that you're looking at here. It's a play off of the classic asset class performance quilt that has been in the industry forever. That quilt typically makes the case for why you should be diversified amongst various asset classes and how unpredictable asset class performance is from year to year. For our modified version here, we're showing the managed futures constituents that make up the SGCTA index. And the point is that it's incredibly difficult to pick a manager that consistently outperforms the asset class itself. In fact, there's a big risk of underperforming it by a lot. Now, we know that managed futures is a powerful alpha-generating alternative for portfolios, but if it's this difficult to get the benefit of managed futures with consistency, why not simply replicate the best attributes of the asset class, seeking to mitigate single manager selection risk and minimize the fees, thus delivering the low correlation and alpha that clients are looking for? That's the DBMF story. So with that set up, this month's update is called Complexity Crisis in CTA Land, and with that, I hand it over to you, Andrew.
Thank you, Mike. Oh, I love that quilt. Thank you for including it. Um, so the markets, or equity markets at least, have liberated themselves from Liberation Day. And by this, I mean that markets have concluded for now that it should discount bluster and threats and focus on fundamentals, a Teflon economy, AI, etc. In other words, hunt for the signal amidst deafening noise. Now, the keywords are for now. And this is because, as noted in the second bullet point, the macro landscape is as clear as mud. Will tariffs be recessionary, inflationary, or both? Was the much talked about demise of the American exceptionalism trade another head fake? Will the big beautiful bill give us a big beautiful bond market tantrum? What new geopolitical headache will pop up in coming months? So enjoy the relative calm as we are, but please make sure that you keep your market disaster prep kit fully charged. Which brings us to managed futures on the left side of the page. DBMF ended May flattish and is down 2.9% or so this year. The SGCTA index, hereinafter referred to as the hedge fund index, was down 1.8% last month and is down 8.4% this year. That's roughly 500 basis points of underperformance this year relative to replication after 500 basis points of underperformance last year. Which brings us to the third bullet point on the right, the complexity crisis in CTA land. Now, in recent years, there's been an arms race among CTAs to add more and more markets and more statistical bells and whistles like vol controls to add diversification, quote unquote. So the question is, if they don't improve performance relative to replication, effectively the strategy beta, then we have to ask, why bother? Why pay higher fees? Why tolerate 100 to 200 basis points higher trading costs, which may not show up in reported TRs, but presumably is a drag on long-term returns? Now, keep this in mind as we flip through the next slide. So this slide shows year-to-date performance of DBMF versus the SGCTA Morningstar category of 40 Act funds and the Bloomberg US Ag. The four takeaways are that A, bonds are doing their job for the first time in years. CTAs overall have been whipsawed badly. Replication underperformed a bit when the euro spiked, but has weathered the market chaos in much better shape. And lastly, the Morningstar category is outperforming the SGCTA index by a fairly decent margin. Now, on the last point, I'll be speaking at the Morningstar Annual Investor Conference later this month on a panel titled, Can Hedge Funds Work Outside of Hedge Funds? Notably with luminaries from Blackstone and AQR, no less. So if you plan to attend the conference, please reach out and let's hang. Things like this will be part of that discussion. Next slide. Now turning to our usual inception to date slide. DBMF now has outperformed the hedge fund index by nearly 300 basis points per annum and tripled the returns of the Morningstar category over 6 years. Now, our drumbeat is that replication is a systematic, repeatable investment process with structural alpha based on efficiency and lower fees. But to take it a step further, as we will discuss in more depth on upcoming Zoominars and webinars, in this space, we believe strategy beta is better. The practical implication for any RIA or model builder listening is this. When building capital markets assumptions, when evaluating single manager alpha, when benchmarking performance, use the index SocGen built around a replication engine. We think that's actually a cleaner representation of strategy beta than the other options. Now hit Mike and he can direct you to on how to get all that data from Morningstar. Next slide, please. So here's our slide on volatility adjusted positioning. Now the overall portfolio narrative is mixed, somewhat predictable given recent market moves. We remain long gold and crude oil, likely helpful if inflation returns, the dollar crashes. We are modestly long the yen and against the euro, and maybe that's an idiosyncratic bet on Japan hiking rates while euro cuts. We're somewhat long the front and middle of the treasury curve, which kind of says recession more than inflation or bond market tantrum. And lastly, we're still slightly long U.S. non-U.S. equities and short U.S. equities, a remnant of the trade around the end of the American exceptionalism in equity markets. Now, just one thing I would note is, given how volatile the markets have been, I expect our positions to continue to rotate as the space hunts for new opportunities. But now let's turn to year-to-date contribution. Next slide, please. So the story this year is relatively simple. Long gold was the big winner, while short the euro was the big loser. Now, interestingly, these can both be thought of as bets in part on the US dollar, but with some nuance here. Gold is a bet that inflation can erode the value of fiat currencies, which is a real and growing concern given the largely inflationary policies coming out of Washington. The short euro position was based on the market view that US economic growth would outstrip Europe's, so a relative value play within fiat currencies. The tail risk event was that geopolitical threats would lead to fears that foreign holders would sell US dollar assets and that Europe would rearm and shake off its economic malaise. And obviously that we were on the wrong side of that for a couple of months. Now, the latter cost us more than the former helped. And so in any event, extending across the other asset classes, whipsaws in treasuries and rates cost some performance, while equity exposure has helped a bit. Now, with that, I'll pass the baton back to Mike.
Okay, thanks, Andrew. So I'll wrap up here with long-term performance numbers for DBMF, which, by the way, has now passed its 6-year track record in May. So annualized return since inception, including the month that was May 2025, is now 6.3%. It's ahead of the SGCTA index by 290 basis points annualized, and it's ahead of the Morningstar systematic trend average by 420 basis points. Long-term outperformance against the traditional diversifier for equities, that being bonds, as represented by the Bloomberg AG, it remains well intact. DBMF outperforming by 532 basis points annualized. So thanks as always to our clients and to our prospective clients for your confidence and your interest in DBMF. If you have more questions about the strategy, would like further information, or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com.